Welcome to Bull DNA. This is Advanced Option Strategies course, and in the previous video we have discussed a bull debit strategy which has limited losses and a greater risk reward ratio. This is the second part of this course, that Advanced Option Strategies course. This is the part 2 of this course, and in this part we will again discuss a bull strategy. However, this time we will not use calls, we will use puts instead, and this will be a credit strategy. So we will collect net premium in this strategy. So let us begin. So first of all, disclaimer, an important one: all the advices or presentation produced in this video are for your information and education purposes only, and before taking any trade, kindly do consult your financial advisor. We are not responsible for any profit or losses that may occur to you. So strategy number 2, bull put spread. So we are playing for bull strategy. We are going to use puts. So let's see what are the nature of this strategy. Again, a bull strategy. The important part, this is a credit strategy. So you will be collecting net premium. Of course, it is a direction strategy. It can be implemented by intermediate level of traders, because this is a credit strategy, and credit strategy requires margins. If you look at the debit strategy, generally they don't require heavy margins, but in case you are collecting net premium from the option buyers and you are option seller now, you will be requiring good amount of margin. So this trade is suitable for a certain level of intermediate traders who have some experience in the options. So the profit level is limited in all the credit strategies. The profit level is limited to the net premium collected. Is limited, and the risk level is also limited. You will wonder if this is a credit strategy B, that is, I am net selling the option, then why the risk level is limited. We will find out when we will discuss the detail of this strategy, that in this strategy we sell options, and in order to hedge that position we buy some options. So in that context the risk level is also limited, but the important point to note here that the risk reward ratio in this strategy will not thrill many traders as compared to the bull call strategy. So the risk reward ratio is not as good as bull call spread. So what it is actually, what is bull put spread and when to use it? So what is it? Bull put strategy is a credit strategy which involves selling at the money or slightly out the money put options and buying further out of the money put option. So let's say if a stock is trading at $100 and you are hoping that this stock is going to rise, you are a bull on this stock. So what you can do, you can sell let's say $98 put option, and in order to protect this position, because if you sell naked put option, you are at an unlimited risk. So in order to protect this position and reduce the margin requirements, what you can do, by selling $98 put option, you can buy a further or out of the money put option, that is, let's say $95. So you sell $98 put option and you buy $95 put option. This is called bull put spread. So when to use it? When we should use this strategy? You should use this strategy when of course you are hoping that the stock will go up or it will remain sideways. So either you are hoping that this stock will go up or either it will remain sideways, and there are little chances of falling. Of course, when you are selling puts, you don't want stock to start falling, because you will be getting in trouble very soon. So first requirement, you are hoping that this stock is going to rise and it will not fall below your sold level of put options. So selling at the money put or slightly out of the money put options helps in playing the sideways or bull market run, and buying further OTM puts provides hedge in case market turns negative. So this is a very simple strategy. You are bullish on a stock or sideways on a stock, you sell the put option and you buy the further out of the money put option. This strategy should be used when you are moderately bullish and it will not fall below beyond a level of support. So this was what is bull strategy and when to use it. So this is just a pictorial example and the prospective payoff of using this strategy. So this person is bullish on a stock which is currently trading at $100 and he thinks that it will rise in next month, but he also don't want to sell naked put option because he has fear. If one day some news come out and this stock start falling, so he don't want to be in a position of selling naked option, or you can say that he does not have that much margin or deep pocket for selling naked put options. So what he can do, if he is bullish on a stock and he also feel that it can also come down, but and he want to protect its downside, then he can implement this bull put strategy. So what will be the different scenario and different profit and loss? So in order to make this bull put spread, what does he do? He sold one lot of put option of $100 strike price for $3 per option and bought $95 put option at $1 per option. So in this way he received a net premium of $200, that is $3 minus $1 into 100 lot. So he received $200 as a premium from option buyers. So what will be his profit and loss on the date of expiry? Supposedly the stock fell to $90. That means his prediction goes utterly wrong, and instead of rising the stock falls to $100 to $90. So what will happen in case stock falls $90? The $100 put option that he sold will expire at $10, and the $95 put option that he purchased expired at $5. So now he is liable to pay net $5. So what would be his loss? He has to pay $5 per option and he sold it for $2 per option. So his net loss would be $300. $5 collected, $5 now required to be paid, and $2 earlier collected. What would be his profit and loss in case stock expire at $95? The $100 option will expire at $5. The $95 put option will expire worthless. So what would be his profit and loss? His profit and loss would be the same, because now again he is required to pay $5 to the option buyer. So from comparing both these examples, you will find that his loss, his downside loss, is limited after $95. So that means for the strike price for which he bought the option, his downside loss are limited beyond that strike price. So what will happen in case stock expire at $92? So this is the break even point. He collected $2 per option and now the stock is expired also $2 below strike price. So he will be at no profit, no loss, because $100 option will expire at $2 and $95 put option will expire worthless. So now he is required to pay $2 to the option buyer, and he already collected $2 per option, so his profit and loss is nil. What would happen if he does predicted it right and the stock rallies? So in case the stock will rally, whether it will be $100, $110, but $150, it doesn't matter. His profit will be limited to option premium collected, that is $200, because if the stock remains above $100, both the option will expire at $0 and the max profit would be the option premium collected. So this This is the pictorial example of bull put spread, and what would be the profit and loss under different scenarios. Hope you have understood it. Now we are moving ahead. So what are the Greeks? What are the Greeks of this strategy, that is bull put spread? In case you do not understand Greeks in depth, I do recommend you to kindly go and watch our playlist which is made on option Greeks itself, and I'm assuring you that after watching all the videos made by us on Greeks, you will have a confidence in understanding the Greeks. So before discussing this slide, I am assuming that you have a basic understanding of Greeks, and in case you want advanced knowledge, I do recommend you to watching that playlist. So what are the Greeks of this strategy? The delta is positive, of course. You want the stock to rally. The gamma, in the net credit strategies, the gamma will always be negative, because any gapping move on downside, because you have sold puts, any gapping move on downside will create problem for this strategy. So gamma is negative. What is theta? Theta is positive, because you are collecting net premium. So in case nothing happens and stock remains sideways, you will earn daily decay in option prices. And what is the impact with volatility? That is Vega. Whenever you sell net option, you are a net option seller, you want the volatility to fall, because volatility, the more the volatility, the more the option prices will be. So in case you are option seller, you want volatility to fall. In case you are option buyer, you want volatility to rise. So you are a net seller in this strategy, so the Vega will be negative. So if the IV will rise, it will be negative for your strategy. If IV goes down, it will be profitable for your strategy. So these are the initial Greeks of this strategy. So how this bull put spread earns or lose? As discussed earlier, this is the simple strategy. Your maximum profit is the net premium collected, and you will get this profit only if the stock remains sideways or it will rally. And as this is a net credit strategy, however, it is a naturally hedged strategy, so the maximum loss is also limited beyond the bought put option. So you will see in this chart that beyond a strike price, let's suppose this was the $95 in our example, you bought option for $95 strike price. So beyond this strike price, your losses are limited. However, if you look at the graph, the maximum profit is way less than maximum loss. This is generally the case in credit strategies. The maximum profit is limited to premium collected, and maximum loss is always greater than maximum profits. And again, the break-even point is sold put strike minus option premium collected. So this was the payoff chart of the bull put spread. So now the important part: how bull put strategies are adjusted. Supposedly you are bullish in a stock, you are hoping that this stock is going to rally and I will be earn profit from selling put options. What will happen in case market turns negative? Suppose you are hoping that this stock will go up and suddenly a news came, a reverse news or a negative news comes in regarding of this company, and the stock will start falling. So what you will do in these cases? So we'll discuss it here. It is important that you must understand how to adjust a trade, because in stock market or crypto markets or commodities market, trades generally go wrong, because we are not the god. Market is supreme, and we must respect market, and we should be flexible and adjustable enough to make our strategy in line with the current market conditions. So as this is a credit strategy, maximum loss is always greater than maximum profit, and in most of the cases, if the stock starts falling, you should close the trade and search for new trades, because generally when market falls, they falls hard. And when market is falling, you don't want to be a put seller. So if you if you sold a put option and the market turns negative and now you are not confident in the stock, please close the trade, take your losses and find another trade, because it is important to save your principal. You know, trading is not a hoping. You should be professional, and in case your decision turns against you, please close the trade and take your money out. So in case you are still bullish, in case you say no, I still want to adjust this strategy, I still want to earn money from strategy. So in this case there are two possible adjustments for these strategies, and we are going to discuss it here. So if you are not bullish anymore, simply close the trade and take the losses. Nothing to think about. Supposedly a negative news come, and instead of bullish, the stock starting falling, and now you are a bearish on this stock. Now such news has led to change your thought process ultimately reverse, and you are hoping that this stock is going to crash. So what you will do now, remember that now you are betting on the bearish side, not on the bullish side. And also you want to protect your upside losses. In case stock comes down and next day stock goes up, so what you will do, so you want to bet on the bearish side now, but you want to protect your upside also. So what you can do, you can buy more lot of OTM options bought in the first place. So what it will do, supposedly in our example we sold $100 put option one lot and bought $95 put option one lot. So we have sold one lot and bought one lot. So now if you are bearish in the stock, what you can do, you can buy additional lot of this option, that is make it buy 2, and now this strategy will look like bear strategies. Now your downside is open and your upside is losses are limited. We will see its payoff chart in next slide, but by doing additional buying of OTM put option, this strategy will now turn into a debit strategy, and its delta will be reversed. Now first the delta was positive, now the delta will turn negative. It will protect your upside and will open the downside for profits. The new payoff chart will look like a ratio spread, and it will turn the theta negative. So it is important to point out that when you become a net buyer of options, the theta will be negative. So this was the bearish side. Supposedly the stock do come down, but you have confidence in you and you are still bullish on the stock. You are contemplating that this fall is just normal and it will go upside again. So what you can do, you can sell call options. By selling call options, it will give you more credits, more theta decay, and it will protect your downside losses. By selling call option, you will collect more premium. It will protect your downside losses or limit downside losses. However, important to note that by selling call option, now your upside losses are open. So in case stock do really hard and it breaches your sold call option strike, so you will be in losses. So this strategy should be implemented by professional traders only, because it might look interesting and it might provide positive theta decay, but this strategy requires hefty margins and it should be implemented only by professional traders. So what will be the payoff chart in case you turn in your bear put spread into a bear play? Now instead of net credit of put sellers, you are now a net buyer of the put options. So what will happen is, now your downside profits are open, your maximum loss are limited on downside, and your upside losses are also limited in case stock was up. So I think this was a good adjustment in bear puts. This is called the repair of bear puts, bull put strategies. I should write bull here. This is not a bear put, this is a adjustment to bull put strategy. So the adjustment is simple. You buy more lots of further OTM options that bought in the first place, and this strategy will make a net debit strategy with negative theta. However, it will open your downside profits. So hope you have understood this bull put spread, and in case of any query, kindly do comment below. And in order to getting newer strategies, we will be launching more professional strategies coming ahead. So for that, I request you to kindly subscribe our channel and wait for our new videos. So meanwhile, you can visit our website voltdna.tk, where you can find free volatility charts and more option strategies, of course not in video format. And you can also follow our Twitter page @volbusy. So thank you very much for watching.